Now, what I want to do here is, so what happened in 2011, we went through this, 2011 to 2014, and I'm just speaking 2011, but it's really like 2006 to 2014 or 1997 ultimately to 2014, 2015, I should say. It was the Wild West. Like there was no governance really, limitations on what you could illustrate, what you could, the positive arbitrage you could sell this stuff at. And so regulators just kind of needed to, put a governor on it and say, okay, we need to rein this in. There's too many class action lawsuits happening. Too many settlements are being made, and class action suits that are settled and sealed in arbitration that are happening, and too much of that's going on. So we need to do something that limits and regulates the way that these things are illustrated and being sold, and that's when Regulation AG 49 came out in 2015. I'm going to continue this in a second. I see there's a comment here. So you're trying to figure out whether an IUL, or whole life policy is better to gain maximum cash value within 10 years when I'm ready to take a loan withdrawal from the policy. All right. So the answer to that, I would say, in the first 10 years, especially, I would say a whole life policy is going to win from a liquidity perspective all the time. The challenge with this is on paper, IUL is going to win every single time, but life doesn't exist on a spreadsheet, right? And so I would say that by the time you're done watching this, hopefully you can come to your own educated decision once you understand how IULs actually work, how the indexing actually works, how the costs actually work, where the risks actually are, and how the upside potential downside protection story actually functions and can impact your life. You can make a decision for yourself at that point in time. And if you have any questions about it as I go, absolutely feel free to chime in, and I'm happy to do so. So we'll go from there. So in 2015, they created Regulation AG 49A right here, or AG 49. So here's what they did. This is what the regulators did at that point in time. They implemented the HHLM, which is the hypothetical historic look back methodology, right? To determine what the illustrated rates should be. So what did they do? They used a 25-year look back period, which 25 years, everybody would say, oh, that should be good, right? Like that's a long period, that's conservative. We should be able to do that. But the problem is they did these look backs and then they ran illustrations based on the performance of the index, but they did it based on current cap rates and participation rates that really, like I said before, are what drive the performance of the policy. So even though the indexes did really well, and even though this 25-year period is reasonable, and even though the S&P may average 8% over that time, well, okay, that performs well, and it will illustrate well, and it will continue to perform well so long as the cap and par rates do not get reduced. Well, guess what? Over the past decade, that's all that has happened, is that par rates, cap rates, spread charges, all those fees and charges, the way they work, have worked against the policyholder. And so therefore, the policy performances have been worse and worse and worse. That's why I always tell people, your index universal life policy, the performance of your IUL has nothing to do with the S&P 500. It has nothing to do with the index that you're participating in. It has everything to do with the options budget, the options cost, and how those impact the cap rates, the par rates, the spread charges. That's it. Even on these no cap indexes that people are talking about. Now, also in 2015, they decided to rein in the crazy positive arbitrage illustration war. It used to be back in the day, you could actually put in there what you want to assume when people took a loan in retirement. You could put in, yeah, we're going to get them 4% arbitrage, and it would illustrate like gangbusters. It was crazy. It was completely absurd ridiculousness. It was never going to happen in real life. They would never be able to perform that way. But people sold a lot of them, and then there were a lot of lawsuits to boot, right? And so that is what it is. So 2020, what happened was, all right, they said that just wasn't enough. AG 49 wasn't enough. Because what happened was with a lot of this stuff, companies, and Pac Life was the worst when it came to this, they came out with multipliers and other features in the policies that would basically be able to say, hey, according to AG 49, we're not able to illustrate and get a high enough return with a hypothetical look back method. So what we're going to do is we're going to take these multipliers, we're going to inject them into the policy, which basically is injecting more risk into the policy, but they don't talk about that, right? Because they give you upside potential, downside protection. While multipliers add risk, they add upside, but they add risk, which is against the natural spirit of what the product is sold as. And so they sold those multipliers, they added them in, and they made a lot of money. Policies ran into a lot of problems, promises were not kept, more class action lawsuits happened, more settlements were made. And then finally in 2020, AG 49, and by the way, it was not just Pac Life. I'm using them as an example. I got to make sure I make that caveat or that disclaimer there. But in 2020, AG 49A came out where they had to get more transparency, right? So the regulators said, okay, the AG 49 was a good step in the right direction. It did some good things. We're starting to rein this in. But if you notice a pattern here, what you're going to see is regulators are trying to do these things to restrict illustration performance and kind of bring it back to reality, so it's not sold in a way that's manipulative, right? That's not being sold in a way that's like debased from reality, that's going to get people to buy something that they don't understand, or buy something that's going to give them a false set of expectations, right? And so what happens is, like I said, back here, they did 1% arbitrage. Now 49A came out in December, I believe, or November of 2020. And so this is during the pandemic, obviously. And so what did they have to do? They had to get more transparency. Companies had to define what their hedging budget was. Now, what is a hedging budget? Hedging budget is basically the options budget that they had. When you put your money into a life policy, it's important to know it doesn't just go into your policy. It goes into the general fund of the insurance company. They get you a return. They have to manage your money like with their fixed account, with their general fund. That kicks out a return. Portion of that return creates a hedging budget or an options budget. And then they take that and they buy options based on what the options costs are. And then based on those two things, they're able to set the cap rates, the par rates, and the spread charges. That's it. It doesn't matter if it's a capped product, a no cap product, a product that focuses on participation rate, a product that focuses on spread charges. At the end of the day, if we're dealing with the S&P 500 index, you can't draw blood from rock. What you see is what you get, whether it's an uncapped index, whether it's a spread charge index, a par rate index, a capped index, whatever. At the end of the day, the same options budget is purchasing the same options at the same cost, and that's going to lead to a very specific result. So how they utilize different cap or index strategies, whether it's no cap, par rate, spread charge, whatever, that's all smoke and mirrors. It's all like you have to understand how these work on the foundational level before it even matters what kind of index you're choosing. Does that make sense? Somebody give me like a 10 if that makes sense, right? Because like, so I am against IUL. So I'm like, so okay, Giovanni. I am against IUL. The reason I'm doing this video right now is because I had a guy come out and make a video debunking some of my IUL content. And in that content, it's just quite frankly BS. Like, I mean, it was just full of half truths and just little snapshots, just to like great talking points, but not full of any factual data. So what I'm doing here is I'm like trying to take this and really educate people as to how this stuff really works. Because what I know to be true, and a lot of people ask me, Chris, like, hey, if you sell whole life, why do you spend so much time railing on IUL? Well, the bottom line is like there's literally probably 10 IUL agents out there right now for every one whole life insurance agent. And with that said, I know, and I run into this every single day, where people are being misled and misrepresented about what Index Universal Life is, how it works, how it can work in their life, what the expectations they should have in it are. And so I think one of the things that I was put on this earth for was to educate people about Index Universal Life and how it works. I just feel a calling towards it. I feel like it's my responsibility. I feel like most people in the industry aren't willing to, yeah, I've already disclosed it, Zach. I used to work with National Life Group. Yeah. Yeah, I'm past all the times of my non-competes and all that stuff with them. And that's why I gave my license up a bit, initially, was because I was dealing with a non-compete with them, and I was going to get my life suit away from me. So I just gave up my license to not deal with it. And so that is what it is. But so like, this is the biggest thing. I'm just trying to educate people how this stuff works, because I do believe a properly designed whole life insurance policy is the cornerstone foundational asset that almost every single person should be utilizing. The problem is a lot of IUL agents are taking the historical success of whole life insurance and they're bastardizing the concept, and they're trying to sell it like infinite banking. They're trying to sell it like IUL has all these guarantees and safety nets and all these things, when nothing could be further from the truth. Let the debunking when someone sends you an in-force illustration. Yeah, that's the thing. Hey, what's up, Jimmy? Man, good to see you. That's the thing, man. Like, I keep getting these people that are saying, "Hey, Chris, like, can you show me a 10-year illustration that hasn't worked?" It's like, oh my gosh, like, sure. I'm actually, so funny thing. One of my partners the other day was like, "Hey, you know what we should do? We should start an IUL challenge to find the worst IUL and pay somebody like a rebate, like give them $1,000 and like create this challenge to get all the illustrations that are absolutely atrocious." Which I think I'm going to do. And then I'm going to like pick the one that was the worst, the person that got screwed the most. And I'm going to give them $1,000 just as a rebate, just because I think it'll be really beneficial. It'll create a lot of really good conversations. And this is the other thing I want to say about the IUL challenge. It is possible that somebody 11 years ago, 10 years ago, sold an IUL and that IUL performed, right? And that, like, if the IUL agent was hyper conservative and they set low expectations, which hardly any of them did because they wouldn't have sold very well. But I do know of a couple people. Like, I have a buddy that runs an IUL MGA, managed general agency. He's the only guy in the IUL industry that I actually trust that writes the business, because he designs them to function like whole life policies. Now, would I do it that way? The answer is absolutely not. He has his reasons for doing it. He's not taking me up on the IUL challenge because he doesn't want to fight with me and go public with it. And he wants to stay kind of behind the scenes. But I know for a fact that this is possible. If you wrote an IUL 10 years ago with lower expectations and you did that, and now it performed at 7% or 6.5%, and you funded it properly and you overfunded the target premium and you did all these things, it could perform. Now, I'm fully aware that maybe some point in time, somebody like a Doug Andrew, who, by the way, has created illustrations and put them on YouTube debunking me, saying he's done it, and he's got these policies. And it's like, okay, you could do that, and that's great. And maybe he does. I'm not going to say he doesn't, but the reason he's not submitting it to me is because he knows that my whole goal is not to avoid like paying $1,000. I'll give him $1,000. I'll give him $2,000 if he'd come on and debate me, because what he's worried about is he knows my next conversation is going to be like, all right, it's great that you had one, but you've sold over 1,000 policies. So like, how many of these do you have? Right? Like, now show proof that out of the 1,000 policies you sold, you probably don't have 20 or 25, maybe 30 that have performed. So if 95 to 98% of these policies are not performing as they were sold, to me, that is completely the antithesis of what whole life insurance does. That is the antithesis of why people are buying the IUL in the first place. And so that's why I always say, IUL is not a horrible product. It's not a horrible product if your expectations are in alignment, if it's funded properly. The problem is it's the most misrepresented, misunderstood financial product. And the sad part is life insurance companies have been fighting with regulators, right? Like I'm showing you here, they're fighting with regulators, and they train agents improperly because all they care about is selling this stuff, right? So what happens is agents are not trained they're only trained according to what the wholesalers tell them, and they don't really understand how this works inside out. And so therefore we got a bunch of uneducated derelicts out there. No offense to anybody that's doing this, because I know you mean and are intentionally well, but like the bottom line is, I guarantee you don't understand what you're selling. If you're selling IUL right now in full faith, full expectation of yourself that you're doing the right thing by people, my promise to you is you don't understand what you're doing, because that just is what it is.